All right, let's just jump straight into this. We're looking at a wildly misunderstood financial tool today, one you have almost certainly ignored, but which actually acts as a massive stealth wealth multiplier when you really understand it. Honestly, there's a very good chance you've already turned this account down. You know the drill. You were sitting in some boring open enrollment meeting, maybe half paying attention, and when this medical account was brought up, you probably assumed it was just some mundane debit card for doctor bills. You picked your standard insurance, closed the tab, and went on with your day. Well, in this explainer, we are going to unpack exactly why that 10-second click might have quietly cost you more money than almost anything else you do this year.
To really get why this matters, picture two identical employees. They work the exact same job, make the same salary, and suddenly they both get hit with the exact same $11,000 hospital bill. Now, one employee pays that 11 grand using money the government never even got a chance to touch, but the other, they're paying with money that has already lost close to a third of its value to income and payroll taxes. Think about that for a second. Before that money ever even hit their checking account, they effectively had to earn $16,000 just to clear the 11 grand needed for the exact same surgery. The gap between these two people isn't their income. It's literally just an ordinary account that one person understood and the other person clicked decline on. So here's a quick roadmap for this explainer. We're going to cover the open enrollment mistake, then look at the famous triple tax advantage, dive into the stealth wealth playbook, break down the brand new 2026 HSA expansion, go over the math and the downsides, and finally give you a concrete action plan. Okay, let's kick things off with Section 1, the open enrollment mistake. There is just a massive contrast between your HR rep's boring 30-second pitch and how financial advisors actually leverage this tool. Your HR department probably spent, 30 seconds describing the health savings account, or HSA? They frame it as this simple little debit card used for copays if you happen to pick a high-deductible plan. But they totally skip the vital truth. The HSA is actually the single most tax-advantaged account the U.S. government allows a regular person to open, period. High-net-worth financial advisors? They definitely don't view it as a medical debit card. They call it the stealth IRA, and they use it strictly for tax-free compounding over decades. Moving on to Section 2, the triple tax advantage. To grasp why this account is so uniquely powerful, we have to look closely at how the American tax system normally operates. Most retirement accounts ask you to compromise, right? Take the traditional 401k. It skips taxes going in and while it's growing, but you pay ordinary income tax when you finally pull the money out. Then you have the Roth IRA. You pay taxes on the way in, but it grows and comes out tax-free. Basically, every account skips one or two taxes. But the HSA? It's the only account in the entire tax code where the government agrees to skip its cut on the way in, during growth, and on the way out, as long as it's used for qualified medical expenses. The IRS literally never takes a single bite. But hold on, because there's actually a hidden fourth advantage here that people miss. If you contribute to your HSA directly through your employer's payroll system, you also skip the 7.65% FICA payroll tax. That's the tax that funds Social Security and Medicare, and you pay it on almost all your other income, even your 401k contributions. So by routing your money through payroll right into an HSA, you skip federal tax, state tax, and FICA. Depending on your tax bracket, you are essentially getting an immediate, guaranteed return of nearly 30 cents on every dollar before the money is even invested. That is just incredible. Which brings us to Section 3, the stealth wealth playbook. First up, you have got to beware of the spending trap. The average person puts money into their HSA, gets a $200 dentist bill, and immediately swipes their HSA card. So by December, their account is sitting at zero, and they have completely thrown away all that beautiful tax-free growth. But the wealthy, their playbook flips the investment switch. You max out the account, leave the money entirely alone, and physically log into the portal to click Invest, putting those funds into broad market index funds. When a medical bill arrives today, you just pay it out of pocket with regular cash. Because remember, every dollar you pull out of your HSA today is a dollar that stops compounding forever. You are effectively spending your future self's money just to save your current self a minor inconvenience. So the absolutely crucial point here is leveraging what's known as the shoebox strategy. Here is a truly mind-blowing fact about HSA rules. There is no deadline on reimbursing yourself for a medical expense. None. Zero. You could pay a $400 dental bill out of pocket today, leave that equivalent $400 in your HSA invested to compound for 30 years, and just save the receipt.
Fast forward 3 decades, and that $400 has grown significantly. Because you kept that old receipt, which basically acts as a tax-free withdrawal coupon, you can legally withdraw that original $400 completely tax-free to spend on a vacation, groceries, a new TV, literally anything. The receipt is just the paperwork that makes the withdrawal legal, but all that massive decades-long growth in between, that is entirely yours, totally tax-free.
And the strategy gets even safer thanks to what we call the age 65 pivot. Now, normally, if you withdraw HSA funds for non-medical reasons, you get hit with a brutal 20% penalty on top of ordinary income tax. Nobody wants that. But the moment you turn 65, that 20% penalty completely disappears, vanishes. From that birthday onward, your HSA acts exactly like a traditional 401k for general, non-medical spending. You just pay ordinary income tax. But for medical spending, which includes your Medicare Part B, Part D, and Advantage premiums, it stays 100% tax-free. It literally morphs into a two-sided retirement tool with absolutely zero downside. All right, Section 4, the 2026 HSA expansion. Let's look at the new rules. So if you thought you were locked out of this, listen up. A huge new law took effect in 2026, breaking down the gates that previously kept millions of people out. Historically, you strictly needed a high-deductible health plan to even open an HSA. But now, if you're enrolled in a bronze or catastrophic plan from the Affordable Care Act marketplace, which, by the way, covers millions of freelancers, gig workers, and self-employed folks, you automatically qualify. Plus, telehealth usage before hitting your deductible is now permanently allowed. And you can even pair your HSA with a direct primary care monthly flat fee arrangement, up to $150 a month for a single person, without losing your eligibility. This newly opens the HSA doors to roughly 10 million Americans. That's a game changer. Let's get into Section 5, the math and downsides. Let's talk numbers. And I promise you, this isn't hype, it's just incredibly straightforward math. If a single person just maxes out the 2026 self-only limit of $4,400 a year, actively clicks invest, and lets it grow at a standard historical market return of 7% for 30 years, it grows into roughly $440,000 of completely tax-free capital. No taxes, ever. For families, the limit is $8,750, meaning that exact same strategy yields well over $800,000. Considering a retiring couple today is estimated to need nearly $250,000 just for healthcare in retirement alone, having this specifically dedicated triple tax advantage bucket, that is the ultimate financial safety net. But as an explainer, we absolutely have to be grounded and honest about the traps here. First up is the heir problem. If you leave this account to anyone other than your spouse, the account instantly loses its magic and becomes entirely taxable income for them in the exact year they inherit it. Second, those required high-deductible health plans, they do expose you to high out-of-pocket costs. If you have chronic illnesses or expect heavy, ongoing medical care, a traditional plan might genuinely be cheaper for you overall, even without the HSA tax break. And finally, the moment you officially enroll in Medicare, you are legally cut off from making any new HSA contributions, though you can, of course, still spend down the existing funds. Let's bring it all together with Section 6, your HSA Action Plan. So here are your exact 5 steps to execute this today. First, verify your specific plan eligibility during open enrollment. Remember, bronze and catastrophic plans now count for 2026. Second, set up your contributions as direct payroll deductions to make sure you capture that massive 7.65% FICA tax bonus. Third, do your best to hit your maximum limits if you can. That's $4,400 for singles and $8,750 for families. Fourth, and please do not skip this step, physically log into the portal and click Invest to move your money out of that default zero-interest cash option and into low-cost index funds. And fifth, start a dedicated physical or digital folder today and meticulously archive every single medical receipt from here on out. But I want to leave you with a grounded final thought here. Ultimately, this brilliant account is really just an amplifier. It multiplies the money you put into it. If your underlying budget lacks the margin to leave these funds invested, like if a random medical bill would immediately force you into high-interest credit card debt, then honestly, you should just use the HSA cash to pay the bill. The advanced compounding strategy is absolutely a privilege of having margin. So before you obsess over optimizing a clever tax loophole, shouldn't mastering your core spending habits and creating real margin in your life be your very first step? You now know more about the stealth wealth power of the HSA than almost anyone else. But the real question is your financial foundation strong enough to let it work? Let that sink in and start building your margin today.